All right, hello everybody, hello traders. Good afternoon. Good afternoon. Hello.
Hello.
Is anybody still with us after today?
Hey.
Man, today was so boring, just like we expected.
Yo.
Today is August the 21st, Thursday. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All trades made by me are placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure is the same as it was. It's the same as it was. It's the same as it was. Actually, those VIX options that I have in here expired, so I need to. Whatever. Those are gone. Everything else is the same as it was. It looks a little clean in here. With some of the shorts I got out of and some of the options I'm not in anymore. The position disclosure is looking pretty clean. I'm only in 22 positions. Only in 22 positions. All right. We had a down day today. Again, SPYs are down 0.4%. Qs are down 0.5%. The IWM is green, 0.3%. The RSP, though, is down 0.35. Real quick look at bonds. They're down small. Gold's still in range. Oil is up decently. Bitcoin looks terrible. IBIT's down 1.75%. That chart looks really bad below $64. Bitcoin not looking good. Sometimes that has a little bit of a read-through on risk. Sometimes it doesn't really mean much at all. Anyway, popping over to the charts here, starting with the intraday index chart. I can spend about 5 seconds on this unless anybody has a question about it, because it's sideways. We gapped down. We did at 10 a.m. actually have a nice bounce back and fill the gap. But overall, today was, what was it, Josh?
Sloppy-Choppy.
The Sloppy-Choppy. It was such a boring Sloppy-Choppy day that we made a song, we made a dance about it, and it's just range-bound action, guys. This is how range-bound action is. You shake out lows, you shake out highs, you shake out lows, you don't get any follow-through on trades. You know, it did look like we were trying to break support at 110. That lasted for 17 minutes, then we snap right back through it. That is just exactly how these range-bound trading sessions go. They're boring. Qs, same thing. If anything, the Qs are even more boring, and the IWM was relatively strong. What we predicted in the morning meeting today was pretty much exactly true. We said, you know, we're going to have a range-bound day today. Most likely, we're going to stay between yesterday's low and Tuesday's high. I'm going to continue to say that those are the most important near-term levels, is yesterday's low and Tuesday's high. So we'll see if Jerome Powell shakes things up in any way tomorrow to get us to break through those levels. That's really what we're waiting on at this point. I agree with what Pat was saying when he was on the radio. You know, a few trading sessions ago when we were at highs, it really felt like the risk was to the downside, and we were pricing in like 100% cut for a 100% chance of a rate cut in September. That's come down a little bit, but last I saw it was still like 82%. So I would argue that the risk is still to the downside more than it is to the upside if Powell comes out hawkish. That's not to say that the market can't go up if Powell comes out dovish and is more dovish than expected. I just feel that, you know, there's more room for this market right now to trade lower if he comes out hawkish than there is for him to trade higher if he comes out dovish. So we'll see what happens tomorrow, but today was exactly as expected. Tight, boring, inside day. I guess the SPYs did technically close below 636. They closed right on their 21 EMA. I'm not getting too excited about that. We're closed 15 cents below the important daily chart level in front of an event. So let's see how the event goes. If the Qs can get below 560 tomorrow, it really marks a change of the market going from bullish to neutral to bearish. If the SPYs can get below yesterday's low tomorrow, it'll make them a little bit more neutral. The IWM had a great snapback today, closed right back above 225. So this Russell is still looking pretty darn bullish overall. And, the only other thing I would really say is, we made a lot of jokes in the morning today, and that's fine. It's good to have a little levity once in a while when we're having a slow day. But it is a serious business because we're all working with our money here. And I think that the biggest lesson that anyone can take from today, which I've been trying to emphasize all morning throughout the trading session, is not every trading session is created equal. A big part about trading is knowing when to be really aggressive and really go for it because all the stars are aligning. There's phenomenal opportunity, there's phenomenal risk reward, and really pushing it when those opportunities are there. You put the cards down and you let things play out. Other situations, other days, today was really one of those days. You need to know to do the exact opposite. So easy today to overtrade, to churn away money, to create opportunities that aren't actually there and hurt yourself. And you got to just recognize, hey, today's not the day on a Thursday at the end of August, right in front of Jackson Hole, Jerome Powell. It just doesn't make sense to push the envelope today. And if you came in with that thought process, you didn't hurt yourself. Maybe you try to pick a spot here or there with small amounts of risk to make $1 or lose $1, but you're not pushing it today. You're not hurting yourself. Really, the only thing I did today besides managing my swings per my pre-established game plans was put on a meta day trade. I actually made more money in this than I expected, but there was relative weakness here in the beginning of the day. You had 2 inside fives in a row. That broke to the downside. I kind of front ran that a little bit. Had a good price, covered some on the way down, was kind of just giving my out to highs, my stop loss to highs. And then I kind of just, I did what I do, which is I manage these positions. I'll take these range days. I know they're not the best days in the world, and a lot of times traders really struggle with them. Personally, I'll take them all day because I just work the ranges for cash flow. And you could just see that's exactly what I did with Meta, just working it back and forth in $1 increments, covering some, reloading it, covering some, reloading it. And then at the end of the day, I was like, you know what? I'm up some money in it. I don't need an extra short on my books. I've got plenty of short exposure. I don't need something extra going into Jerome Powell. I'm just going to take my money and run on the trade and move on. And that's pretty much exactly what I did. And that was pretty much my entire day was, just managing my positions back and forth a little bit for cash flow, BSing a little bit with Josh Leffler and William Jones over in the compliance department and Amy Eisenbach, the chief of staff here at T3. And that's all there was to do today. So that's all I got. I'm happy to answer any questions that anybody has on anything. I'm not in a rush. I also understand that this could be a really slow short meeting because whatever it was a really slow day. But it's also an opportunity if anybody on the team here is struggling with any concepts, any broader concepts, market psychology concepts, risk management concepts, reward maximization concepts that you might want to spend a little time asking some questions on that we can review. I'm happy to do that as well because I'm really in no rush, but totally up to you guys on what we do here. From Liam, do you hate the idea of walking on a day like today? Do you think you should sit at the desk and learn from the price action, or is that over analysis and almost bad? I don't think there's very much to learn from the price action itself today. I got mixed feelings on the answer to your question. On the one hand, I would say that there's not really anything wrong with taking a pretty long midday break on a day like today, getting a couple things done, getting a couple honeydews done, some chores done, whatever, because there's not a lot going on. I don't think that there's very much to learn from today's price action, but I also think that even if there's not something to learn from today's price action, if you view trading as your job like I do, then you want to be constantly putting in that extra work. And that doesn't always mean analyzing the day's price action on a day like today, but there's other things that you can do to help improve and to learn. You could be reading a book, you could be watching the latest Jem Carson options video that Mike Reed I think posted in the VTF yesterday morning. There's a million things, especially if you're a new trader, that you can be doing to to learn, even if the price action is not where that learning is actually coming from today. Hopping into a book, yeah, that's fine. Getting a workout in midday today on a day like that is fine as well. So yeah. I got the cars washed today, ran a couple errands. Yeah, for sure. From Scotty, I didn't do much today, but study. Can you talk about one of your cash flow strategies? Sure. I can do that. What I would actually rather do, because it goes really deep when you ask that question, is I don't know, does anybody here have access to the link? I don't know if Mike Reed is listening today. Have access to the link where Mike Reed has pulled out the different lessons from previous afternoon meetings and timestamped them? Yeah, Liam, if you could put that in there. Scotty, I'm happy to answer the question and get into it. What I would rather do is actually start by directing you to the spreadsheet from Mike Reed, so you can go back into some previous lessons where I've gone into heavy detail behind how the math works on some of the cash flow strategies that I implement. Let you use that as a basis point, and then in tomorrow's Friday, so we're not going to do an afternoon meeting tomorrow, but then after you've kind of watched that, if you've got questions on what I do and how I implement that further, really happy to jump into that on a afternoon meeting on Monday or Tuesday or early next week, whatever, if that makes sense. So we'll just wait for Liam to share that.
I try to buy low and sell high.
Thanks, Josh.
My strategy.
Thanks, Josh. From Dave S. Bigger picture, are we as a room here expecting the eventual pullback of the market to be just a 5% correction during seasonal weakness, geopolitical unrest, something else, or do we see something bigger like April lows? So that's a really good question. I think just because you've been working with me for a while, Dave, I shy away from, generally speaking, the really, really big calls. I find that really big calls are great if you want to sensationalize things on CNBC, but I'm not, here to, make like my favorite exercise to not do that everyone does on CNBC is on the first week of January to say where the S&P is going to close at the end of the year. I just think it's the stupidest thing ever. You have no idea what is going to happen over the course of a full calendar year to be able to make a prediction on where the S&P is going to end at the end of the calendar year. It's just like one of the silliest things. So I personally like to shy away from those really, really big picture, very, very wide calls, and instead prefer to implement more of a process-based approach. A process-based approach where you start by looking for something, but you leave it open to turn into something more. So odds over time of cuts. Thank you from Polymarket.
Who put that together?
Who put what together?
The spreadsheet.
Mike Reed.
Fantastic
Yeah, this
job,
has been
Mike Reed.
This has been shared before.
I only come every now and then.
So I think, Scotty, not to get off topic, I'll circle back to the question because I just pulled up the spreadsheet here. I assume it's under quant increments in this. If anybody's watched these, you actually might know better than me. I've never gone back in and gone through these. This is such a great...
this is amazing. Whoever put this together, this is amazing.
Yeah, for sure. I'm surprised that he only has one of those in here, because I know I've done a bunch of afternoon meetings in the past talking about the cash flow stuff that I do, but I think it would be the one to start with would be under quant increments. I think you should start there, and again, if you got further questions beyond that, we could talk about it on Monday or Tuesday. Anyway, back to the question on are we expecting...
There's a whole section, range cash flow trading.
Where is that? Range cash flow trading?
Yeah.
How far down?
Line number 132. My guess would
Oh,
be,
there you go.
yeah,
There
my
you
guess
go.
would be that is-
So I don't know what the quant one is that I just referenced, but check that out. And then the bigger one is probably range / cash flow trading, and he's got 4 different links here on different afternoon meetings that you can check out. It's a pretty deep topic. Anyway, back to the question. Are we expecting an eventual pullback to just be 5% or something bigger picture? So what I would say to you is one step at a time. Right now I'm looking at the 3 indexes. The SPY is like bullish neutral. The Qs are neutral. The IWM is bullish, right? Overall, we're still pretty neutral to bullish. So honestly, even calling for a 5% pullback is a very big call when you're looking at indexes that are in an uptrend and are technically really bullish. I am calling for that though. I'm calling for like a 5 to 7% down move overall in the indexes. I've been saying that, since we were at highs here. And that's, based on an understanding of the systematics and positioning and seasonality and kind of where we're at. Does that turn into something significantly more? The not great answer is maybe. But that's the most truthful answer. It could. It could certainly feed on itself, and much of that depends on how the events evolve, especially as we're working through that seasonally weak period of time. How bad or not bad do the economic numbers actually get during the deterioration? Like, how bad do tariffs impact growth and inflation and employment? I've been saying this for a long time, and I stand by it. The only way that you would get like a major sustained cyclical bear market, in my opinion, is if we really saw a deterioration in employment. I think that is the real bear market unlock, if you will. And that's the number one thing I'm watching. And sure, the Fed can cut, but first of all, there's so much chatter on the bullishness of a Fed cut. I would note, even though we got a couple Fed cuts in 2024, historically, the first couple cuts from the Fed actually are correlated to down moves in the market. And I think that people forget that because we're just so used to, it means that there's like easing coming in from the Fed, and therefore that's bullish, and therefore the market should go up. But actually, historically, it doesn't always have to be this way, but historically when the Fed begins to cut, they're beginning to cut because the economy is worsening, and the market tends to shrink even though the Fed is actually cutting. And you go through, a deeper cyclical bear market. But what has been the one thing that has stayed steady in all of this in April, even in the down move in March, in April, in the up move in May, in June, in July, in August? What is the one thing that has stayed steady? Hasn't been systematics. Systematics were big sellers and then massive buyers. It has been the corporate buyback, but the corporate buyback goes into blackout windows, so there's periods of time where the corporate buyback bid is not there in the same way. It has not been hedge funds. The one thing that has been the ultimate steady bid that's been buying dips and buying highs has been retail. The only way that you lose retail, the retail bid, is if the unemployment rate begins to tick up. If people begin to become fearful that they are not going to be able to have a job in the future, then they don't invest in the stock market, which is risky, in the same way that they would otherwise. They don't or if they lose their job, they don't have the money coming in that they're able to spend to dollar cost average into the stock market like they've currently been doing. And potentially, they even become forced sellers because they need to take the money out of the stock market to live because they no longer have employment. So I think that the biggest key to a more sustained bear market, the biggest key to seeing a potential retest of an April low, which is not something that I want to predict, but I do actually think it's a possibility, would be that you really begin to see the unemployment rate begin to tick up. So, for the moment, I just want to take things one step at a time. We are in a market that has slightly deteriorated from a bullish S&P, bullish NASDAQ, and bullish Russell to a bullish neutral S&P, neutral NASDAQ, and bullish Russell, right? So there's a slight deterioration there. And I'm actually looking for that to further deteriorate. I'm looking for 5, 7, 8%, pullback in the S&P, not just the NASDAQ. The NASDAQ is working on that already, in the S&P. And then seeing if that can turn into more. And I do think it can turn into more, but it's going to be heavily dependent on the evolution of these economic numbers. And it's hard to predict. I would argue, for me personally, we're very, very slowly beginning to see the impact of tariffs on prices, just as an example. But it's been much slower than I expected. And even now, like, we're only just barely seeing that when you look at the earnings report from all these companies that just reported. When you look at the earnings report from Walmart that just reported, they said that they, have basically not really started to increase prices, that they have a little bit, but they also said that, like, now week after week after week, they're seeing their cost of goods rising, and they're going to be passing that on. So it takes time sometimes for these things to bleed into the economy. And when you think about the consumer, like the U.S. consumer that loves to spend, they're such big spenders. I like to make the Long Island jokes, and I'm from Long Island originally, so I feel like I'm allowed to. But I also think it's true. Like, a lot of Americans, not just in Long Island, but they're a special breed, pretty much everywhere in the country. They're gonna spend on credit. They're gonna try to keep up with the Joneses. They're not gonna want to pull back on the lifestyle that they've become accustomed to until they actually have to. So there's a chance that could last for a while before it really begins to deteriorate. So, the timing on that's a little bit difficult. And once we start to get into the November-December period, the seasonality becomes really bullish. It's hard to be a bear in November and December, traditionally speaking. So for me, I think, like I've been saying for last week or so, there's a real window of opportunity here for bears to take the reign in this back half of August through September, especially if we can see a further deterioration in the economic numbers, especially if that is coupled with a hawkish Fed that does not want to cut because inflation is going up at the same time. That could extend itself through October. What was it, October 2023, where we had a really weak, this exact period of time, and then it bottomed out in October? Let's go have a look. I'm pretty sure it was. Yeah. Here it is. So we topped out in April. We had a really strong July. We had a really strong first half of August. We had a really weak second half of August. This right here is Jackson Hole. This is the big, this is 2022. Maybe it's 22 that I was thinking of. Hold on, I want to look at 2023 also. Let me go back real quick. Because in 2022, I'll start with 2022 because I have it up. But I think what I'm referencing is 2023. I remember this day. Does anyone remember this day of this absolute bottom here in October? That was a CPI day, and it was a hot CPI. Does anyone remember this? Oh my God, that was the craziest day. This was the craziest day back here on October 13th. It's cool that all these afternoon meetings are in the YouTube and they're labeled. I bet that would be an interesting afternoon meeting to go back and watch. The afternoon meeting of October 13th, 2022. Look how big this daily candle is, how big this gap down is, and how high this close was. And pre-market, we traded significantly lower than that low. And that marked the bottom of 2022. And then in the back half of October, we were strong. November, we were strong. And the first half of December, we were strong. That's the 2022 bear market. And you can still see the positive seasonality that occurred. But what I meant to reference was 2023. So let's go back to, let me zoom into 2023. Here it is. This is, I think, potentially more similar from a seasonality perspective to what we're looking at now. All right, so strong July, weaker August, but first half of August was a little slow, droopy to the downside, but overall weaker August. And then September, you can see the real weakness, like August weak but choppy, right? That's like normal. I feel like in August you probably had big buybacks going on that month. Then in September, you lose that. You had real weakness. October, we stayed weak. We bottomed out at the end of October. I remember I was in vacation. I got back from vacation on like October 25th, and I was reading the updated CTA information, and it pointed towards starting basically like November 1st that the systematics were going to go into full-on bull mode. And I remember basically at the bottom on like this afternoon meeting on the bottom saying, guys, I'm buying everything I can possibly get my hands on. And then in 2023 here, this November, December was like two of the best months I ever had in my career. And it all started with buying massive swings pretty much at the bottom in October because we were looking at the systematic data that was coming from Goldman and Nomura, combining it with an understanding of seasonality. Right, this is really a strong seasonal period, that November, December. So anyway, likening back to now, this is kind of more of what I've been expecting. A choppier August. I think it's fair to say that we've gotten that, even though we did push to new all-time highs this current August. It's overall been choppier. The second half of August, unlike 2023, I'm expecting more weakness than in the first half. And that makes sense when you understand the dynamics behind the systematic funds and how they've played out in this month. And then I'm expecting that to lead to further weakness in that traditionally seasonally weak September. And this is everything else out equal. Like maybe we get some great economic numbers and helps the market hold up. Maybe it does the opposite. There's no way I can predict those things. Weak September. And then October, I think, going back to Dave S. and his question here, I think October is a little bit of a wild card. Are we plummeting into some real economic weakness with employment really declining, unemployment picking up? That could lead to a significantly weaker October where you're actually getting follow through from September, or are things not as bad as otherwise expected, in which case we're holding up? And I get the answer to those questions that I don't have the answer to right now is the answer of, is this like a 5 to 10% pullback, maybe a 12% pullback, or do we go into a full-on bear market and correct down 20% and revisit some of these levels from May or even April? I don't think it's impossible. It's just not a call that I'm willing to make because I don't have a crystal ball. I can't see the future. I can't know exactly how bad or not bad the economic numbers are going to get, but I can take it one step at a time. I can know the CTA triggers. I can know what the vol control funds are going to do, and I can know when crash, right? The when crash document that gets shared all the time here in the VTF that comes from Charlie McGilligan. It's so great. I can know when all those circumstances are coming together that create the selling and the squeezing that leads to the break of those systematic levels that lead, and that, by the way, that's the biggest thing that I learned about trading over the course of the last 5 years, is that it really is all about the systematics. I've spoken about it very publicly. I had a really bad June of this year. I had a really bad trading month in June. And it was because I did something in June that I haven't really been doing very much of at all over the course of the last 5 years as I've started to learn more about this, which is I fought the systematic bid. Because in my head, as someone who's more of a trained economist as a background, I'm thinking about how bad tariffs are, and I'm thinking I could fight this systematic bid, and I just totally hurt myself as a result in the month of June. That's really what it's all about. So circle back to, could we ever test April lows again? Well, you have to combine this worsening economic data, higher unemployment, with systematics being in the right place to be able to actually enable the bigger selling and the bigger crash to occur. And then, yeah, it becomes a possibility. But we got to take that one step at a time, right? Let's start with, can this market go from being bullish to being neutral to being bearish? Can we get an increase in realized vol? Can we get the first CTA sell trigger to trigger? Can we lose 6,200 support? And as that's happening, are we seeing the economic numbers get worse? If all that lines up perfectly, you could see April lows retest. If even a couple of those things I just mentioned don't line up perfectly, then you're not going to see April lows get retested, but you could see a 5 to 10% pullback. So great question. I hope that helps. Thanks for posting that, Dave. From Dave S. Like, if I'm in a short that I have from a good price on a day one Maribozu, then I don't think I try and keep a trailing position beyond the correction area. Maybe that's the wrong thought process. Infinite bid will be back at some point. It will be back at some point, but it'll only be back when there's ammo for it to be back. The systematic bid doesn't have much left to buy. The way that so this is how the cycle works. The way that the infinite bid comes into the market is because there was selling that was forced to occur that is being reallocated back into the market. That's what this was. And this was just a huge case study, by the way, of something that we've seen happen in microcosms over and over and over again that I've also spoken about in the past, which is, if you look at like this uptrend in 2024, 2024 was a great year. Market was up a lot, but you can see that there's these like kind of, you know, pullbacks throughout the entirety of that big uptrend. And if you studied the systematic positioning in real time as these were ongoing, you know, when it comes to like that concept of everybody being in the pool from the perspective of the systematic buyers, it doesn't mean that you need to go down. It means that the risk becomes to the downside. I remember, if you go back to 2024, I remember this really vividly, at the end of February, the systematics were looking like they were fully in the pool and the risk was to the downside. But the uptrend persisted for the entirety of the next month of March before eventually giving way in April. We were able to, even though everybody was already in the pool, we were able to grind up in an uptrending market for an entire month before the pullback occurred. But at the end of February, we knew the risk was becoming to the downside from a positioning perspective. Then we got the pullback in April, right? And I'm not going to bother to measure what percentage this is, but it looks like a 7% pullback, just eyeballing it. So you got a 7% pullback. What that 7% pullback did was all the people were in the pool from the systematic perspective, then they got out. Like, maybe not all of them. It was not as extreme as what we saw in March and April, where the systematics got massively short, but they sold a lot. And then when they sell a lot and the market restabilizes and volatility comes down and they begin to buy. But the thing that I want to point out that is super notable is that the systematics weren't fully in the pool again until like the beginning of July. But look at how much higher the market is, right? They owned 100% of what they can buy, basically at like 523 in the SPYs. Had to sell a bunch, started rebuying again, right? So here's your infinite bid. After they sold, your infinite bid comes in for another, couple of months here. And then when they were fully back in the pool again, it's like 550. It's $25, $27 higher to get them fully in the pool again. And then it was the exact same thing with pretty much all these pullbacks. You get the big pullback, you get a lot of systematic selling, then they begin to re-leverage to the long side, and it's a few months later and it's a significantly higher price that it begins to happen again. And then it happens again, and then it happens again, and then we got this really, really extreme example. And you can now use the extreme example, right? In February of 2025, the way that I was able to make the bear call as the market broke all-time highs here at February 19th was because I knew the risk was to the downside for the systematic funds. If it triggers, the risk is to the downside. They're 100% in the pool, and the risk triggered, right? It really triggered. We had an event, and it was much more extreme than the pullback I just described because they didn't just sell everything they owned. They sold everything that they owned, and then they went short. They sold so much that then when the bid came back in, right, so they're fully in the pool at SPY 610, we only saw here at, really mid-August that they were fully in the pool again, but now it's SPY 645. They're 610, 645. you add on an extra $35 to the price in the SPY just to get back to the same positioning levels. And that's what we see over and over and over and over again with how the market actually works in these recent years. That's just been 100% how it works. So one question that you might ask, which I think is a great question to ask, is, where is all the other buying coming from? Because obviously there's other buying that's coming in. Otherwise, it would be that the systematics were fully in the pool at the exact same price again at 610. Or in the dip example that I just brought up, they were fully in the pool at 520, then they were fully in the pool again at 550. Where is the $30 of premium coming in that first example? Where is the 610 they were all in, 645 they were all in? Where's the $35 of premium coming in the second example? It's everything else. It's retail, it's 401k buying, it's in a huge way corporate buybacks coming into the market, companies improving over time as well. That's where all the additional buying comes from that leads to that next leg higher. This is what actually creates that roller coaster effect in the stock market, where you can have these peaks and valleys and these pullbacks and continuation periods. That's what creates the cycle. So to answer your question, and it's a great question, should I just get all out once we have a 5% pullback in the market? Because the infinite bid's going to be back at some point. You're 100% right. The infinite bid will be back at some point, but only after they dump. Is the dump going to be like a couple of these 2024 corrections like I just discussed, and then they're re-leveraging again? Or is it going to be a similar or even worse situation to what we saw in March and April? I don't have the answer to that question because it depends on all the other circumstances around it. Is retail selling? Are the corporates, which have been buying back stock at a rate that's never been seen before at a massive rate, hit a point where they become so fearful of the economy that they feel the need to start storing up cash and stop doing that in the same way? The answer to those questions are how you get something that we have not really seen in a very, very, very long time, which is a prolonged bear market. The closest thing that we've seen to a prolonged bear market, really in my entire trading career, is in 2022, because we had to raise interest rates massively in order to fight inflation that was a result of COVID, supply chain economics. And we had a very long bear market in 2022 in terms of duration, but not in terms of depth. But unless you traded the financial crisis, which is just before I really got started trading, you've never seen a prolonged, consistent bear market that lasts for a long period of time where unemployment is rapidly picking up. And I'm not calling for that. I'm not predicting that. But if you want to know how the cycle of just these bigger picture higher lows always comes in, that has led to, from retail, this massive buy the dip mentality from everybody in retail. How does that cycle end? It circles back to what we were just talking about before. It's employment. The only way that you lose the retail bid in the market is if you see a big spike in unemployment. I remember graduating college in 2008, and the unemployment rate was 17% or something like that, 15+%, I think, when I was graduating college and trying to get my first job. I promise you, if you see 10% plus unemployment, you're going to be looking at a very, very different S&P. Again, I'm not saying that that's happening. I'm not saying tariffs are going to be the cause of that. I have no idea what could be the cause of that. It probably will eventually happen someday, somewhere, next year, 5 years from now, 20 years from now. I have no idea. I'm sure you'll see it again. But that's how you'll see a real bear market that doesn't lead to the dynamic that I was just describing of you wash out the positioning, then you get the infinite bid. And the question is, when does the infinite bid come back? Well, how much do they sell, and why is it happening? And I don't have the answer to that question, like I keep saying. Time will tell. What right now we are seeing a move higher in unemployment, but the statistics are actually interesting, right? Because the unemployment rate hasn't really increased because the amount of people who are available to work in the United States is being reduced at a similar rate to which the amount of job openings are being decreased. That's something that Jerome Powell was talking about in a recent Fed meeting as well, which I found fascinating. So yeah, I mean, we'll see how it plays out, but that's a great question and really lets us dive into some important market dynamics. From David L. I have a tape reading question. I noticed a constant buyer in Palantir at 155 showing size from 1150 to 130. Was looking for a possible sell through 155. However, it kept holding support. In general, if you see a strong buy or sell order on the tape at a certain level, is that a possible sign to avoid trading through that level? I know today was a range day, but was curious what a good practice would be at observing a large buy or sell orders in the tape. So, David, hard for me to answer that question without actually seeing it, because there's so many different ways in which a buyer can buy. So I would say to you, next time you see something like that, just send an alert out in the VTF to me so I can have a look, and I'll do my best to watch it for a little while so I can actually give you some more feedback.
I'll jump in on this one for a second, just because I was trading PLTR so closely. You don't even need the tape. I mean, just look at the 5-minute chart, right? Like, you can see the support at 155 all day long. So, I mean, yeah, like, the bid is there, and it continues to tail off that 155. So, in theory, like, do you want to jump the gun early and kind of, as Derrick calls it, cheat on that break of 155? Probably not, because every time that it breaks 150, like, every time that it tests that 155, it immediately pops up. But in theory, if you are watching the tape and you do see it trade through 155, right, there's going to be a lot of guys, sometimes Derrick included, that look for that kind of trade right back through 155. Although in this case, if you're looking to short it, like, just wait for it to break 155. It never really did. I mean, you're talking about 1130 to 1150 to 130. It never broke from 1150 to 130. It never broke 155 once. So if you're watching that and you notice that, like, it's not to say you should shy away from it, because honestly, if it ever did break that 155 anytime after that, like, that's probably a really good short, because whoever is supporting it at 155 is gone. So I don't really necessarily agree that, like, if you see a strong buyer or seller on the tape at a certain level, is that a possible sign to avoid trading through that level? I mean, yeah, it's support at that level, but if it ever breaks it, like, that could be a fantastic short. Now, obviously, with the tape being the way it was today in general, like, anytime we went to anytime we looked like we were going to break down, we popped back up. Anytime we looked like we were going to break up, we popped back down. And that's just kind of the choppy action in the market in general. But specifically with PLTR and specifically with what you were seeing, I saw the same thing too. Now, I tried to range trade it a little bit, right? And I did pretty good with it. Like, I made a couple of bucks here and there. But yeah, I mean, to your point, like, yes, there was clearly a buyer giving support at 155. Had that broken through it, like, I, in my opinion, think that's a fantastic short intraday, not necessarily on the daily because of how extended we are. Like, there's a lot of things that go into that, but yeah, I would have thought that was a fantastic short if that 155 broke. And you don't even necessarily have to take that short through 155. A lot of times what can happen on that is you can actually see how it trades through the 155, and then 155 becomes resistance if it holds below that. So while you might not necessarily catch the initial, like, flush bar through, like, let's just say it flushed 155 and instantly went to like 154 and a quarter. Like, yeah, you would have missed 75 cents there, but chances are, because of that flush, because of hitting the stops at 150, whatever happens there, it might have traded back up to like 154 and a half, 154 and 3/4, and then you can really look for some sort of pivot to then use 155 as your established kind of resistance area where you can say, hey, now I'm going to short versus this 155 if I didn't even catch the 155 break. So that's my 2 cents. Sorry to cut you off.
Thanks, Josh. I think that sometimes shorting the break of a buyer can be very profitable, and sometimes buying in front of the buyer can be really profitable. And I think it pretty much is really dependent on the circumstance. Would be my short answer after the information Josh provided. From Greg M. And wildcard, but before you can count on the infinite bid, you should consider, does a prolonged bear market associated with some huge spike in unemployment significantly decrease the fund inflows into these CTA strats that are behind the infinite bid? Did it happen post 2008? I don't know, but I'd be willing to bet it didn't. The 2-year bull market enriched the trend following CTAs. They are flush. Yeah, I agree. Not sure that would be the case after an 08 or 2022 like market. Yeah, generally speaking, I agree, and I think in 2022 they did just fine. 2008, I have no idea. Great thought process there. Over to the YouTube for Robert. Do you even start pure cash flow trades without a major position on? Yeah, I do. For Meta today, I took it as a day trade with a stop loss, but then I had a game plan where I could bid out down every dollar down to 7.25. So if it went all the way down to 7.25 intraday, I'd be out. And then if it ranged above 7.25 without ever triggering my stop loss, I was just going to work the range for the day. I don't love them as much as a pure day trade, but it works intraday as well. But you kind of need a stop loss, and you can get triggered on the stop loss. I just didn't in Meta, so I was able to work it all day. Ethereum is printing an inverse head and shoulders. Let's take a look at ETHA. The ETHA ETF, an inverse head and shoulders? I don't see it. Basically, it was just at all-time highs. How could it be printing an inverse head and shoulders? I don't know. I would need you to draw the map out for me. Which sectors should not be affected by Fed talks tomorrow? They're all going to be affected. It's just that they'll be impacted differently. A lot of times the financials trade differently than the rest of the market. Defensive sectors might trade different from tech. Things that are more interest rate sensitive will trade different than things that are less interest rate sensitive. So it could be winners and losers. It's hard to say. Like if tomorrow's not a disaster, but he scares the market a little bit, you might see some money come out of the IWM or come out of tech, but rotate into consumer staples and utilities, things that are more defensive. We've seen that happen recently. Or if he says something that really scares the market, then correlations will increase and they'll just sell everything. From Denny's, have you ever heard of strategies with negative correlation? Stock over SPY. I don't know what stock is, S-T-O-C-K. I feel like I've seen that before.
I think he's saying, like, if you put a stocks chart over the SPY chart, if you put an individual stocks chart over a SPY chart and look at like the correlation between like a negative correlation, where like in theory they should come back to par. I don't know.
It's like a pairs trade?
Kind of, I think.
For example, W 10:20 a.m. entry point is something like this. W at 10:20 a.m. entry point. I'm sorry, I gotta be honest, I'm not really sure what you're referring to, so it's not really something I have an understanding of. It sounds like you're talking about some degree of a pairs trade,
actually what I think he's talking about is like if you pull up the W chart, assuming I'm following what he's saying. If you pull up Wayfair's chart at 10:20 a.m., right? It's like kind of just lower, consolidating back into like the ADMA, but if you pull up the SPY chart at 10:20 a.m., it's like ripping back up to highs. I think what he's really just talking about is relative weakness and relative strength, like in general compared to the index. Which, I mean, is obviously a huge relative weakness.
Yeah, so as a concept, if that's just relative, if you're comparing individual stocks to the SPY, I use that to understand relative strength and relative weakness. And if I see the SPY bounce back really well, but a stock is unable to, I know there's relative weakness there. I mean, that's kind of what I was describing with Meta earlier. One of the reasons why I shorted it was because Meta, I felt, was not trading as good as the Qs. If you look at the second 5-minute bar on the Qs, they're breaking highs and price correcting to their 8 and 21 EMA on the 5-minute. If you look at the Meta, it had an inside bar here. The SPY bar, the Q bar closed at highs, but the Meta bar closed with an upside tail. So I just felt that there was some relative weakness there compared to the SPY. So when I wanted to try to short something, I went after Meta because of what I had noticed in terms of its relative weakness. Thank you for the question. I hope that helps. From Scotty, indicators like RSI and MACD are showing some toppiness. How much weight do we put into those? It depends on the trader that you're asking here on the team. Some of the guys here on the team, really like to lean on their indicators. I personally do not. I'm super, super clean with my charts. It's exactly as I show them all the time. 8 and 21 EMA, Japanese candlesticks, volume, that's all I look at. But then if you look at like Pat's morning note, if you look at the technical analysis portion of Pat's morning note, you'll see, he doesn't have the Ichimoto clouds in here anymore. But he used to have Ichimoto clouds in here.
He ditched the Ichimoto.
I think he had to switch his program, and the new program didn't have the clouds, if I remember correctly. But he used to have Ichimoto clouds in there. He's got Bollinger Bands. He's got different moving averages than I use. I know that Pat and a few of the guys on the team here are big users of the RSI on small time frames. But I've heard Pat say he doesn't like it on the daily chart. You'd have to ask him why. MACD I've never used. So the one thing I would say...
Hold on, let me just also say this before Derrick gets into what this all is. Right. Somebody who uses RSI and uses MACD, Derrick's been trading long enough and seen enough price action intraday that he's looking at the exact same thing that the person who's looking at a high RSI or a low RSI is looking at. He just doesn't correlate it to, hey, this is where the RSI is reading at this exact moment, but he's seeing the exact same thing that the RSI is indicating at that moment. But he's seeing it because he sees price action, he sees something that's kind of, been had a ton of momentum and all of a sudden is losing its kind of steam, or is kind of, losing its kind of momentum towards the top. And that's going to mark some sort of RSI reading that somebody who follows RSI is going to be like, yeah, look at this RSI. But Derrick knows that in his head. He's just not correlating it to that exact thing, saying, hey, look at the RSI on this. But I can almost guarantee you that if Derrick calls out, like, hey, I think this is getting toppy here, I think this is getting towards the bottom here, at that exact same moment, if you ask someone, what's the RSI on that stock at this moment, it's going to correlate to a very high or low reading showing almost the exact same thing. I don't know if that makes sense.
Yeah, thanks for that, Josh. I think there's a compliment built in there somewhere.
I think so.
But what I was going to say echoes kind of what Eli just said here, which is I'm not against any technical indicators at all. I'm really not against any of them. I just need traders to remember what they are. An indicator indicates something. That's literally all it does. It indicates something. So the most important thing is actually price and what price does. And the problem that I have with indicators, especially with newer traders, is I see them sometimes traders become overly reliant on them, where they are only really looking at the RSI or the MACD divergence and foregoing the actual layers of probability and the price action itself. I am a big fan of using, even though I don't use them myself, of using indicators as a layer of probability. So if you go back to like my probability class that I have, where I discuss these different layers of probability, I would say that indicators are an additional layer of probability for when you like other things. So for example, I know for my own trading, sometimes I'm looking at, an extended 5-minute chart and something that's going crazy and I'm thinking about shorting it. And the first thing I do is I'll ask Pat about it usually, because Pat's a better, more patient counter trend trader. I tend to be a little early sometimes. And I'll ask Pat about it, and he'll give you some information, and then I might ask, does anyone have the RSI on this? What does the RSI look like? And or sometimes traders in the VTF will just say it, and that's great too. They're just like, oh, and the RSI is at whatever. And I'm just like, oh, that's interesting, because I was already thinking that this is probably a short, and you just provided me an extra piece of information that's acting as a layer of probability, that is acting as further confirmation of what I'm otherwise seeing. So I got no issues with any of them. I just think that you need to make sure that you use them properly. And I've seen people become overly reliant on certain indicators to their own detriment over the course of my career, especially specifically the MACD.
Yeah, I mean, if you rely on RSI and MACD as your only two indicators that you're going to trade off of, and you trade anytime they're at extreme readings, you will lose a fortune. Is basically what it comes. Like, you have to build. If you're going to use indicators, you have to use them, like Derrick said, as layers of probability on top of other things. Because ultimately, if you just rely on one thing, you're going to blow yourself up.
Yeah, the VIX is another important layer of probability off of what Dennis just said here. So it's also something we're paying attention to, the VIX and the VVIX. From Steven in the YouTube, do you ever take note of SPX dealer exposure levels? I think what that is basically what we're seeing when we're looking at gamma. The gamma number indicates what the S&P dealer exposure levels are, and what the direct impact is on the market of certain movements. So yeah, that's what we're looking at. For sure. All right, so I'll wrap it up there. This meeting could have lasted 10 minutes. It lasted an hour and 10 minutes, and that's because you guys had awesome questions. So that's great. You know, this is how we all improve as traders. I know there's a bunch of you guys that are newer traders, and sometimes you're shy on asking questions. Don't be shy on asking questions. It's the only way you learn. It's the only way you improve. So keep it up. This was one of the most boring trading sessions I can remember, but one of the better afternoon meetings I can remember. And that's all because you guys had great questions. Have a great night, everybody. I'll see you all tomorrow.
Yeah.